What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, we are going to have some fun breaking down a pretty awful Dave Ramsey video where he's hating on whole life insurance like he usually does. It's what he's best at. And it's not that, like, I don't really care if people hate whole life insurance. If it doesn't make sense for you, then don't do it. I don't care. You know, go buy term and invest the difference. Whatever makes sense for you. What I have a problem with is when people like Dave Ramsey provide very, very misleading, inaccurate, wrong information about whole life insurance just to sell or promote whatever it is they're trying to sell and promote. Because what happens is it leads people to make financial decisions based on wrong information. When you hear Dave Ramsey talk about whole life insurance, yeah, it sounds like it's really bad, but everything he says is wrong. And that's what I want to do in this video, is just address and debunk everything he says, because almost everything he says is incorrect. And my goal is to give you guys the actual facts and information that you need to make the best decision for you. When you understand how whole life insurance works, at that point, you can decide whether or not it makes sense. Maybe it doesn't. Maybe it does. It absolutely did for me. That's why when people say they hate whole life insurance, like, so you hate one of the most powerful financial products in the world, at least that I've come across. I mean, these things are incredible, guys. When you set them up correctly, you use them properly, oh my God, we get so many benefits from these policies. Now, again, does that mean that it's right for everybody? Of course not. But my goal is to provide you guys with how these things actually work so that you can make the best decision for you. Because I'm telling you, Dave Ramsey is not giving you all the information about whole life insurance. He's just promoting his buy term and invest the different stuff, whatever. And it's really frustrating. And unfortunately, you know, the caller in this video, you know, he takes what Dave Ramsey says at face value. He's probably not going to do any of his own research. He's listening to Dave Ramsey, who is the so-called expert, when in fact Dave Ramsey gave him all the wrong information about this thing. And you know, these policies can make a really positive impact in somebody's life, but if you don't understand how they actually work and you just listen to people like this, you know, how do you know you're making the best financial decision for you and your goals and your situation if you don't have all the facts? So we're going to break down the video. I'm going to show you my actual illustration for my own policy as well. We're going to look at a couple of other sites and documents and whatnot just to disprove everything that Dave Ramsey says here so that you have all the information. All right, let's get into it. Let's have some fun.
Very much for your advice. My question is, I've heard you talk a little bit about whole life policies. Now, my wife and I right now have whole life policies. They're good until we're 125 years old. We have about $1.5 million in coverage. Costs us about $680 a month to have that. And I've heard you sort of say that you didn't think they were a great investment, but I haven't really heard you get into any details about why you think that is. So I was wondering if you could just talk about that a little bit, and you know, maybe I'm missing something, and if I am, I'm sure you'll. Okay,
so let's clarify this first, guys. Why whole life is not a good investment? Well, it's not an investment at all. It's life insurance, guys. Whole life insurance is not an investment. So when people like Dave Ramsey compare it to mutual funds in the stock market, it's like you're comparing apples and tater tots, guys. Like they're just not even in the same ballpark, not even in the same game. They're nothing even remotely close. Like, how do you compare that? A much better comparison for whole life would be savings vehicles, maybe bonds. So savings accounts, bonds. Like when you compare those two things, now whole life insurance, it's kind of a no-brainer. Because when it comes to investments, when people refer to whole life as an investment, usually what they're talking about and the only thing they're focused on is rate of return. Here's the thing, is with a properly designed high cash value whole life insurance policy, dividend paying, mutually owned company, et cetera, you're going to net typically around 3 to 5% tax-free compound growth every single year. That's pretty good for a savings vehicle. Now, if you compare it to an investment like real estate or the stock market, is the rate of return anywhere near as good? No, obviously not. But that's only one small aspect of it, of the conversation that needs to be had. You're talking about the tip of the iceberg here, when underneath is this foundation of all these amazing benefits that we get from these policies. So only focusing on the rate of return, that's not why we set these policies up. I like to refer to the internal rate of return of these policies as just a bonus that we get. It's not why we set them up, though. Can it accumulate, build into a pretty significant number later on down the road, 30, 40 years? Absolutely. But it's not why we set these policies up. So just be careful with that, guys. We're not trying to compare this to investments. we're comparing this to savings vehicles. Like whole life insurance is a really good savings vehicle where we have that safety. We don't have the volatility of the market. We're going to get that 3 to 5% tax-free compound growth every single year. We've got the living benefits, the death benefit itself. We can use our cash value. So we have liquidity, like all these other benefits that we get. So just keep that in mind. It is not an investment. It is life insurance. All right, let's get back into it.
You'll hit the point.
Okay, sure. Well, the overarching main companies that sell whole life, the numbers break down about like this. Per $100 that you pay in premium, you can buy the same amount of term life insurance, 15-year level term, 20-year level term, for about $5.
Got it.
It's roughly 20x.
Okay, so he is talking about the cost of the death benefit, and he's right in the sense that whole life is going to be more expensive for the same amount of death benefit than it would be if you got a term policy. And if you just stop there, yeah, whole life sounds like it's awful. But when we actually dig deeper, which one is truly more expensive? The one where you lose all your coverage and you lose all the premiums that you've paid, so you have literally nothing to show for, or the one that builds up equity, which is the cash value? You'll always have the death benefit your entire life. It's going to grow with the cash value every single year. You're going to still have all the benefits of the policy where you can use it for emergencies, investment opportunities, et cetera. That's borrowing against the cash value. That's the liquidity aspect. We have, we can potentially create tax-free retirement income later on down the road. So which one is actually more expensive? And here's the other thing that I want to show you guys here really quick. I want to pull up a compound interest calculator. Like once I understand the concept of lost opportunity cost, it just completely changed the way that I think about money. So let's say over the course of 30 years, you paid, it's probably going to be a little bit more. I guess it depends on how much coverage you have. But let's say over 30 years, you paid a total of $10,000 for a really cheap term policy, like a 30-year level term policy. All right, we paid $10,000 for that coverage, okay? And I'm not bashing term insurance here, guys. It absolutely has a place for it. I'm just trying to make a point about the, like when he's saying it's more, whole life is more expensive. So if we take 4% here, because just taking the middle number between the 3 to 5% we would get in the whole life policy, let's call it 4%. What does that actually cost us over 30 years? Did the term insurance cost us $10,000, or did it actually cost us over 3 times as much in lost opportunity cost? That's the way I think about this. Like, because when you have nothing to show for that term insurance, all that money is gone. That money could have been used to continue building your wealth, to continue earning interest somewhere, but instead it's gone forever. Plus, you don't even have the coverage anymore. It's kind of like renting an apartment. Like, again, there's pros and cons to this. But just to give an example, if you rent an apartment, okay, granted, you don't have to worry about the maintenance. Sometimes it's cheaper too, especially if you live with roommates or whatnot. It's cheaper than maybe buying a house. Like, you don't have to come up with a down payment. Sometimes the mortgage payment itself is higher than rents. Just a lot of different factors there. Okay. And you don't have to worry about, if the AC breaks down or you need a new roof, right? So there's pros and cons. And also you're not locked into one place. Okay. But at the end of 30 years, let's say you rent for 30 years, all of that money is gone forever. You're never going to get that back, and it's never going to earn interest for you. So there's that massive lost opportunity cost as well. Whereas if you purchase the house, yes, it costs more up front. You got to put the down payment. Maybe your monthly payment is more. You do have maintenance, et cetera. These additional costs associated with buying the house, but you have the equity. You can get a home equity line of credit. Eventually, it's something that you can sell and eventually potentially make a profit on. It's something that you can pass on as a legacy play to your loved ones. There's so many benefits to it. It doesn't make sense for everybody. But like, if we only focused on like the cost, the upfront initial cost of which one is more expensive, then nobody would ever buy a house. But when you start going deeper and you start looking at all the other benefits and then matching those benefits, seeing if they align with what your goals and your financial situation is, okay, now it makes sense to pay more for the house, to replace the roof every once in a while, but I'm doing it because I'm getting all these other benefits. I'm not just throwing money away and paying more for something and that's it. Like, I'm getting all these other benefits. So it's just another way to think about it, guys. He likes, Dave Ramsey likes to stop at those points right there. Doesn't go into any more detail. But when you start thinking about it this way, okay, buying the house, having the whole life insurance versus the term. Okay, that starts to make a little bit more sense now. So let's keep going.
Okay. And for the insurance, obviously whole life, though, has another component to it that term does not have. You're obviously aware of that. You spend a lot of money on this. And that other component is a cash value buildup. Now, the cash value buildup is the other $95 out of $100 approximately. Could be $91, could be whatever, but it's somewhere in that range. Nationally, across the top 10 whole life insurance companies, it is $95. Okay, so $95 going into cash value, $5 purchases the same amount of insurance, life insurance. Now, so then the gripe that those of us have that hate whole life insurance, and it's not a mild dislike, I hate it, is that what happens to that $95?
It's really bizarre to hear somebody say they hate something that can be so powerful. It doesn't make sense for everybody, but like to have a whole life insurance policy, but we get so many benefits from it. I don't know how you can hate it. It's really bizarre to me.
And in cash value, what you will do, and you're well past this, but if you went back and looked at your policy pages, your cash value buildup for the first 3 years, your savings buildup is zero.
Oh, okay. Not true.
100% of the $95 goes to fee.
Okay. So let's debunk this. Let's have some fun, guys. I'm going to pull up my actual illustration for my own policy here. Now, I do want to clarify. So like what he's talking about as I pull this up here, what he's talking about is a traditional 100% base whole life insurance policy, meaning 100% of the premiums that are paid goes to base. Did you know that you can direct where your money goes in a whole life policy? You can, instead of doing 100% towards the base premium, you could do 25% to the base premium and 75% to what's called paid up additions, kind of like just buying prepaid life insurance policies. That's kind of what it is. But with paid up additions, you get 90 to 95% of that shows up in cash value. And I'm going to show that to you right now in my own policy, because that's exactly what I did. I did a 25% base, 75% paid up additions policy, and look at how much cash value I had access to in the first year. So I put 120,000 in. And if you guys want a full breakdown of my policy, I'll have a link in the description. I did a separate video on that. I'll break down some of it here, but basically what I did is I set up a $25,000 per year annual premium. 25% of that is base premium, which is what I'm always on the hook for. Not my entire life. I meant to bring this up earlier. You don't have to pay into a whole life policy your entire life, guys. You could do a 10-year policy if you wanted, pay into it for 10 years, never have to make another premium payment ever again, yet it's still going to grow at that 3 to 5% tax-free compound growth every year. So keep that in mind. But anyways, so 25% of this premium is base premium. It comes out to like around $6,200. The remaining $18,000 and change is paid up additions, which is at my discretion. So I don't have to pay that those paid up additions every single year, but I structured it that way so I can max fund my policy. All right. I want to put those paid up additions in because most of that shows up in cash value. It's really, that's one of the most important things you need to know about paid up additions. That is what you use to build or get access to a lot of cash value in the very first year. I put 120,000 in. I had access to, so my net cash value here is 108,000. I had access to roughly about 103. They don't give you access liquidity to the full cash value amount, just so you don't lapse the policy. But I had access to $103,000 in the first year. It's about 86%. That's really good for a whole life policy. So what are you talking about? I don't have access to that money for 3 years. That's not true. Now, on the base premium part of it, that is true. You don't typically have access to, it doesn't build any cash value in the first couple of years. But when you utilize paid up additions and you customize the policy, you have access to a ton of cash value, guys. And this is going to continue to grow for me every single year, provide all the liquidity and benefits. Like I've taken out multiple policy loans already to purchase a vehicle. I just consolidated all of my mother's credit card debt. I made my first alternative investment, flipping heavy equipment. Like I'm actually using the policy in my life for emergencies and investment opportunities to continue building my wealth, but my policy is still going to grow at that 3 to 5%. Plus, I have this massive death benefit that would be passed on to my loved ones should something happen to me. So going back to some of his other points, is it a little bit more expensive in the beginning? Sure, but there's a cost to everything. There's no free lunch in this world. You know, it's like in my business, I pay $500 a month for a piece of software that I use. If I stop there, that sounds ridiculous, right? But what if that $500 a month software is making me $10,000 a month? Now, does it make sense? Yes, of course it does. So you can structure your policy, guys, to get access to a lot of cash value in the very first year. You just got to design it properly. Work with people who know what they're doing, have their own policies, utilize it, and like understand this stuff. Not the likes of Dave Ramsey. So we're gonna get into a lot more detail in my illustration here, but I just want to continue with some of the points that he's going to bring up.
Fees. It's front loaded as an investment, which in and of itself is not necessarily evil. It's just frowned upon in the financial planning world by and large. The second thing is that once you do start building it nationally, and again, don't know your policy, but it's not going to be substantially different. The average rate of return on the $95, if you look at your actual cash value buildup, including the 3 years of zeros on the front end, it ends up being an average of about 1.2%.
Wrong.
Let's be generous and say it's double that.
Wrong. Okay. So this is a document I pulled from one of the carriers that I work with. You can get this on their website. It's pretty simple stuff talking about the dividends. With these policies, these are dividend paying whole life insurance policies. And this company has paid a dividend for 146 years straight. Really, really financially sound company. But what does this number say right here, guys? 3.6%. This is the 40+ year internal rate of return of these these whole life policies. And actually, and I have to confirm this part, but one of my mentors and coaches, when breaking down this document, this is actually for 100% base policy, which is the type of policy that Dave Ramsey is talking about. This doesn't even take into consideration if I were to set up a policy 25% base, 75% paid up additions for high cash value, what that internal rate of return would look like, because it would be a lot better than the 3.6%. But even again, let's just be conservative here. It's not 1.2%. He's being generous, saying 2.4%. This is right from the company over the last 40 years. This is what the net internal rate of return would be after fees, expenses, costs, etc. So what are you talking about, man? It's just very misleading information. And then I can hear some people watching this saying, well, 3.6%, that sucks. Okay, again, going back to rate of return with these things, this is just a bonus, number one. And for a savings vehicle, that's pretty good, not to mention the tax benefits you get too, which absolutely factor into the rate of long-term rate of return as well. That's not calculated here, right? And all the other benefits too. But you know, for a savings vehicle, 3.6% compounded every single year, tax-free, that's pretty good for a savings vehicle. It's a nice little bonus. And the other thing that I want to mention though, so this kind of blew my mind as I started going down this rabbit hole, guys. So watch this. So what I just showed you, that's like the net internal rate of return over a long period of time. But what if we look at things, what if we look at it on an annual basis? Watch this. So let's get a few years into the policy here so we can get some good numbers. All right, let's go to when I'm 50. All right, and I've got this set up to pay into up until the age of 75. That's just how I designed it. You don't have to do it that way. Like I said, you could pay into something, a policy for 10 years if you wanted to and never make another premium payment. But anyways, let's go to when I'm 50, okay? Now watch this, guys. At this point, I'm putting in $24,395. So my 7-year term policy has fallen off. I put that in the policy so that it doesn't MEC. It's a modified endowment contract. It raises the death benefit. It's a cheap way to do that, to make sure you don't MEC your policy, which would mean I would lose all the tax advantages. We don't want to MEC the policy. So a term policy allows us to avoid that. And you see here, it falls off. That's why the price adjusts. And also my death benefit decreases pretty significantly. It's because that term policy has fallen off. But my death benefit is going to continue to grow every year with my cash value. But watch this. Let's go to age 50. We're 15 years into the policy. I put in $24,395. Look at this column right here, guys. Increase in net cash value in the same year is almost $50,000. Do the math on that. So I put in $24,395, but that increased my cash value by almost $50,000. What's that rate of return? That's a lot. That's pretty good. In this cash value, I have access to the majority of that. So I could take that money, use it for another investment opportunity while my cash value continues to grow every single year uninterrupted. Because those, when I borrow against the policy, we're borrowing the life insurance company's money. We're going to get into that. He's going to bring that up later. But you see, like, when you start to put the pieces of the puzzle together here, and you actually research this, you actually look at these things for yourself. You don't listen to these gurus and authority figures or whatnot, and just, you take their word for whatever it is that they're saying. You assume they're right. Do your own research. This is how these policies actually work. What other vehicle do you know of where you can put in $24,000 and immediately have access to almost $50,000? That's pretty good. It's just another one of the benefits of these policies. So when it comes to rate of return, yeah, it's definitely not 1.2%. You saw it right here, 3.6. Like I said, on average, it nets 3 to 5%, depending on the design, depending on the company. So yeah, just keep that in mind.
2.4%. Still not a good long-term investment. If I could get 2.4 on my money market, I'd be dancing a jig, but not on my long-term investments. My long-term investments need to be north of 10% to be beating inflation and taxes. And so it's a horrible rate of return on a long-term investment. And those two things are bad, but the stake in the heart of whole life, and the reason the entire financial planning community that are not in the whole life insurance business have abandoned whole life. No one sells this but whole life insurance agents. No one sells it anymore. No traditional financial planner, no SmartVestor Pro, no one in the
It's a shame that they aren't sold more, because when you set them up and utilize them properly, they can be amazing, amazing financial products. They're just awesome.
Financial world sells it. The only people that sell it are whole life agents. They've gone away from it. And this is the reason. Once you've paid the extra $95 to build up, and on your $680 premium, you said you had a $1 million policy?
I've got $1 million. My wife has $500,000, and that's our combined premium is $680.
Okay, so $1.5 million. If you die, your wife, the beneficiary, I assume, would get $1 million. That's your face.
My daughter. It doesn't matter.
Okay.
But yes.
Yeah,
right.
whoever the beneficiary is going to get the $1 million.
Right.
That's what they're going to get. That's all.
Right.
If you have a cash value of $200,000 at 2.4% that you put $95 per 100 in to get to $200,000 or to get to $100,000, none of that. So you have a savings account that for the first 3 years you put in there gives you nothing. After that, it pays 2.4%. And when you die, they keep your money.
No,
all right.
No, they don't. Okay. Actually, I'm going to let him finish his point here. But this is like one of the most ridiculous arguments against whole life insurance that I hear. It's just so stupid.
Which makes it absolutely horrendous. So you're much better off. And many, many decades ago, the financial planning community, by and large, started moving towards
Okay, I guess that was him finishing his point. So the evil life insurance company keeps your money. Okay, let's break this down, because that is absolutely ridiculous. It is not true. I'm not sure why people like Dave Ramsey think that you should get both, or your beneficiary should get both the death benefit and the cash value. It's just a very fundamental misunderstanding of how life insurance works. So what I want to do is pull up my illustration again, and let's break this down. All right. So evil life insurance company keeps your cash value. Now I will say, he said savings account. That's like one of the first somewhat accurate things he said that he'll say in the entire video. But I do want to clarify, this is your cash value. It's not an actual savings account like you would open up at the bank. This is still life insurance. It's really important to make sure that we stay on track with that. Okay. So I'm just going to answer this question. And I did a full breakdown on this, answering this question in the description if you want to check that out. But I'm going to just brush over it really quick. Simple explanation. What happens to the cash value when you pass away? Well, the cash value is technically baked into the death benefit. The death benefit is calculated by taking the cash value, adding the net amount at risk. That equals the total death benefit. So in essence, when people ask me that question, well, what happens to the cash value? Well, your beneficiaries get it. Not technically, like the life insurance company is not that I'm aware of anyways. They don't, they're not looking at it like the simple way to say this is that they're just on the hook for the death benefit. When you pass away, they're going to cut a check for the death benefit. They're not overcomplicating it like we are trying to figure out what happens to the cash value and whatnot. It's a simple formula. When you pass, beneficiaries get your death benefit, but how is that calculated? Well, it's cash value plus net amount at risk. Now, what is net amount at risk? Very simple, guys. If you take your death benefit and you subtract it by your net cash value, that equals the net amount at risk to the life insurance company. That is basically when you look at your cost of insurance, the cost of insurance, whatever that formula is, depending on the policy you have, it's applied to the net amount at risk, not the full death benefit, but the net amount at risk for the life insurance company. All right. We don't really need to dive into that too much more, but just know that the way that the death benefit is calculated is we take the cash value, you add that net amount at risk, whatever it is, that equals the death benefit. That's the check that the company writes to your beneficiary, income tax free. Now, why on earth we think we need to get both? Like, look at this, guys. Let's go to when I'm 80. Let's say I die at 80. Do you really expect the life insurance company to give me both here? Almost $7.4 million. We wouldn't have life insurance companies at that point. But the point of the cash value, though, is a couple of things. Is what it does. Is it shows you how much money you would get if you canceled or surrendered the policy, and it also shows you how much you can borrow against the policy. It's basically your equity in the policy, right? If you were to look at your home and you could see how much equity you have, it's basically cash value is basically the same thing. You could borrow against that if you wanted to. But once you pass away, it's all irrelevant. The death benefit is the only thing that matters. That's the check that gets cut and written to your beneficiaries. How is that calculated? Cash value plus net amount at risk. So can't we argue that your beneficiaries get the cash value, even though technically, like, it's not in a contract or anything like that? But when we calculate it, if we just use common sense and logic about how the basics of life insurance works, well, yeah, it's kind of, the cash value is kind of baked into the death benefit, because also the death benefit is growing with the cash value the entire time. So what are we talking about? They steal and keep our cash value? No, it's baked into the death benefit. It's part of that formula. It's part of that equation. And it would be like, so if you think you should get both, let me ask you this. If you were to sell your home, let's say it's worth $300,000 and you have $150,000 in equity, would you really expect to get both the $300,000 and the $150,000 in equity? Or would you only get your equity? Right. You'd only get your equity. It'd be absurd to think that you would get both. So why do we think we should get both in a life insurance contract? I don't understand. In a life insurance contract, it's even more beneficial than the analogy I just gave, because you get the true value of the contract, which is the death benefit. That's what you want passed on to your beneficiaries. It's always going to be more. These are the two questions I ask people with regards to this conversation is, do you want to pass on more or less money to your beneficiaries? And do you want them to pay taxes on it? They're rhetorical questions. Obviously, we want to send more to them, and we want it to be tax-free. That's what a death benefit allows us to do. So just keep that in mind, guys. The cash value is absolutely part of the death benefit here. The calculation can get a little complicated, but I mean, it's really not that complicated. It's cash value plus net amount at risk. That equals the death benefit. That's the check that gets written to your beneficiaries. All right. So please keep that in mind. Do not be fooled by this ridiculous argument about how the life insurance company steals your cash value. That is absolutely ridiculous.
Buying term life insurance for the $5 per 100 and doing almost anything else with the 95, but over in the investment world, away from the insurance world. Put it in a freaking fruit jar. At least it's there when you die.
Okay.
So is the death benefit. That's cash value is it's baked into the death benefit, guys.
Okay, so you said would your advice be to just terminate those policies and just do what you suggested, purchase relatively inexpensive term life policies and then put additional money? I mean, I do have investments. I mean, I could just up those investments. I invest mostly directly in the S&P 500. I've got a 401k.
Exactly.
So would you
get the term life in place first. first.
Yeah, exactly.
So this is where I have my biggest issue right here is this gentleman is making a potential, like a major financial decision based on wrong information, based on everything Dave Ramsey just told him. He's probably not going to do his own research on what Dave Ramsey said. And now he's going to potentially cancel these policies because that's what Dave Ramsey told him to do. When, like, how does he know that's actually the best decision for him? If that decision is coming from wrong information, that's so frustrating to me.
Get your term in place first. Never cancel life insurance until you've got new in place, because we don't want you to have the proverbial milk truck or bus in the middle between the two.
So just look at the money I've been spending over the last 5-10 years. Just write that off and just start.
It'll make you want to throw up.
Yeah.
But yes.
But that's the case. Now you will get your cash value out by canceling the policies, whatever it is.
Okay.
It doesn't die then. But you never get both.
I understand.
You never get the insurance.
Why would you get both? Why would you get the sale price of the home plus the equity when you sell the home? Like, and you can apply that to a lot of different scenarios, but why do you expect to get both? That doesn't make any sense.
Insurance and the investments, and you're always paying for both. And that's the consumer advocate like us, our reason for hating on these things and just saying they're absolutely horrible. It's an antiquated product from the 40s and 50s that built large buildings in the skylines of almost every city, and that everyone now has pretty well moved away from, except the companies with their name on that kind of stuff. So,
yeah, because all the mutual funds and Wall Street products that he recommends, whatever, they've never built any skyscrapers or anything like that. And have wrecked the economy how many times? Yeah. Okay.
Anyway, all of that to say, now, one last part of this discussion that's worth having, because you're obviously doing well financially and you're doing really good with your analytics on this. The last thing that happens is the irony is that we really don't necessarily need life insurance for our whole life.
Right.
So if you've got $2 or $3 million in your investments and zero debt, and the kids are grown and gone, and you die, well, I think your wife will be okay.
Okay, I think that's just a ridiculous argument. I'm not gonna go down that rabbit hole about why we should always have life insurance. I'll do a separate video on that. I really wanted to point out the specific things about whole life insurance itself that he was calling out. I absolutely believe you should always have life insurance. This whole concept of self-insured, I'm not a big fan of, but that's going to be a different video. I think that's about it for this one. Played a little bit more just to make sure.
I was looking at it as like, I can die broke if I want to, and at least they'll have this much. But you're right in the sense that I won't be able to spend all my money.
Yeah, but if you put the $95 in a fruit jar, you wouldn't die broke.
Right, exactly right. Okay, I'm doing it. Thank you, Dave.
Hey, man, thanks for the call.
Wow. Well,
great discussion.
I thought whole life.
Yeah. So this is kind of the funny part where he starts talking about like infinite banking and how horrible life
going to be like timeshares where it just kind of
is.
dies over time. But TikTok has caused a renaissance of whole life agents to start their financial planning influencer careers.
You're kidding.
And so now
they're like whole life guys that are trying to make it cool again.
Well, they're peddling it with new
terms. Make whole life cool again.
You've seen this: index universal life, infinite banking. Dave,
infinite
the wealth
banking.
This is the hack wealthy people don't want you to know.
Infinite banking is back. That was a scam from like 20 years ago.
He just has no idea what he's talking about. I did a whole video on why infinite banking is not a scam. Make sure you check it out. It's got good stuff. It's just a strategy, guys. And I'm implementing the infinite banking concept in my life with my policy right now. I can personally vouch for it. It is amazing. It is awesome. When set up and utilized properly. Is it for everybody? Of course not. But to say it's a scam when you don't know anything about it, you only know what you want to know about it, what's convenient for you to sell whatever narrative it is that you're trying to push. But I know for a fact in my life, infinite banking has been amazing. It's allowed me to consolidate all of my mother's credit card debt. I purchased my vehicle with it. It eliminated all those the opportunity cost. I used it to make did an alternative investment in flipping equipment and stuff like that. All the while, when I use that money to do all those things that I just said, that money is still growing 3 to 5% tax-free compound growth in my policy right now, as if I never touched it, because I didn't. I borrowed against the policy. I borrowed the life insurance company's money to do those things that I just explained to you, and we pay those policy loans off over time. But the money is still growing inside of my policy every single year. So like with my alternative investments, I'm actually making money twice. And I think they mention like that how idiotic it is to pay interest to borrow your own money. That is so stupid. It actually 100% makes sense to pay a little bit of interest to have to continue to get that uninterrupted compound growth. I did a full video on that too, guys. And the leverage, the collateralized loan that we have here is essentially what we get with the policy loan. It's really, really powerful tool for building wealth, guys. It is incredible. But you have to understand the basics, like the difference between simple interest and compound interest, and how policy loans work, and how we're supposed to use them, et cetera. So again, please make sure you check out the additional training that I'll have in the description. It goes into a lot more detail here. I'm just going to go ahead and wrap this up because we're at the 35-minute mark. I hope that was helpful. I hope that cleared a few things up for those of you that follow Dave Ramsey, or you've heard these things about whole life insurance. It's just so much of it is crap. It's just trash information. So at the end of the day, I'm not saying that everybody needs to have a whole life insurance policy or do infinite banking, et cetera. I just want you guys to have the facts and information about how these things work so you can make the best decision for yourself. All right. And you can only do that when you have all the information. All right. So that is it. I hope you guys found this video helpful. Any questions, drop some comments down below, and I will talk to you in the next one. To your success, Matty Ice is out.